Did one singular Supreme Court decision from 1978 accidentally unleash the era of the 21% credit card interest rate?
And now, what happens if the government tries to yank those rates all the way back down with a flat 10% cap?
That is the high-stakes question we are getting into today. This is a deep dive into the shockwave from a recent proposal for a federal interest rate cap.
And we're stacking that directly against the legal foundation that was built almost 50 years ago in the Marquette Supreme Court decision.
Our mission is to cut through the panic and, the policy spin. We've got the urgent banking industry warnings, some really surprising market shock stats, and detailed financial analyses from the Fed.
We want to understand who wins and who loses if Washington decides to impose these, well, strict price controls on the foundation of American consumer credit.
Right. We're exploring how decades of deregulation, or now maybe re-regulation, shapes the cost, and I think more importantly, the availability of the credit you use every single day.
Let's start with the current crisis.
Yeah, let's jump in. This recent proposal to impose a temporary 10% cap on credit card interest rates, starting in 2026, it wasn't just a political footnote.
Oh, not at all. It was a seismic event for the market.
A panic signal.
An immediate panic signal, especially for a certain part of the financial world. You saw it in real time in the stock prices. For specialized lenders, their entire business model rests on pricing risk for subprime borrowers.
Oh, for them, this is brutal.
Exactly. Synchrony Financial, which is one of the largest issuers of those private label store cards, saw its start price plummet by 8.7%.
8.7%, just like that.
Immediately after the proposal's details broke.
Wow. That's a staggering drop for a single day. And it shows, genuine investor alarm. They see this not as some minor adjustment.
No, they see it as dismantling their entire business model. The assumption is just, well, it's simple. A flat 10% cap is so much lower than the 25 or even 30% that high-risk borrowers pay now.
It would just wipe out the profit they need to cover defaults.
It would wipe it out. And that's where the institutional response gets really interesting. We saw the big banking groups, the Bank Policy Institute, the American Bankers Association.
And all got together.
They issued a rare joint statement almost instantly calling the 10% cap economically devastating. That is not your typical industry boilerplate.
Okay, so what's the actual threat they're making? Because, cap proponents just say the banks are crying poor, they don't want to lose their huge profit margins.
Well, their core warning isn't just about profit, it's about access. They argued that a rigid cap would force them to immediately and aggressively tartan their lending standards.
So they just stop lending to people.
They warn it would be devastating for millions of American families, small business owners, anyone who depends on that credit. The logic is, if we can't charge higher rates for higher risks, we'll just stop lending to those customers, period.
So the market, not the government, has to price the risk. And if the government forces a false price, the banks don't take the loss.
No, they just cut off the supply.
They turn off the tap.
Precisely. They caution that locking risky borrowers out of the system won't make them safer. It will just drive them towards less regulated, more costly alternatives.
They're talking about loan sharks.
They're talking about a return to loan sharking, high-cost payday loans, things outside the traditional, regulated banking system.
Okay, that is a powerful argument, even if it's a bit self-serving. It suggests that this kind of aggressive price control doesn't save the riskiest consumers money.
It could lock them out of the legal financial system entirely.
Okay, let's unpack why the market is panicking so much over this idea of price control. To get that, we have to go back almost 50 years to the legal decision that built this whole modern credit card world.
The 1978 earthquake.
Exactly. So before 1978, the credit world looked totally different. Interest rates were generally capped by state-level usury laws.
Right. And those caps were usually somewhere between, 8 and 12% historically?
Very low. So because of those low caps, cards were often called loss leaders. What does that actually mean in banking?
It just means the bank didn't really expect to make a big profit from your card's interest. The card was more of a service, a way to get you to keep your checking and savings accounts with them, maybe use their mortgages.
To be a loyal customer for their other more profitable products.
It was a marketing tool, not a major revenue engine.
And then 1978, everything changes. A unanimous Supreme Court decision. Marquette National Bank of Minneapolis v. First of Omaha Service Corps. What was the seismic change here?
Well, it fundamentally neutralized all of those state-level consumer protection laws, basically in one move. The court ruled that a national bank is governed only by the interest rate laws of the state where it's headquartered.
Its home state.
Its home state. Doesn't matter where the borrower lives or where they use the card. This gave banks the power to export rates across state lines.
The analogy we talked about before is really helpful here. Think of the U.S. as a highway, and every state has its own speed limit, its own usury cap. Before Marquette, a bank had to follow the speed limit, say 10%, in every state they drove through. After Marquette, the court said a national bank only has to follow the speed limit of its home address.
And if their home state decides to set the speed limit at, say, 1,000 miles per hour,
Meaning no limits at all.
they can charge those unlimited rates to every single customer in the entire country.
And that triggered what was called a race to the bottom.
A fierce one. States started competing to attract these big financial institutions, for the jobs and the tax revenue.
And we saw companies actually move. Who was the first big one?
The most famous example is Citibank. In 1980, Citibank moved its entire credit card operation to South Dakota.
Why South Dakota?
Because South Dakota had just repealed its interest rate caps entirely. And then other states like Delaware, Utah, and Nevada, they all followed suit, passing laws that allowed for essentially unlimited rates.
So today, if you look at your credit card statement, chances are the bank is lending to you out of a headquarters or some branch in one of those deregulated states.
Exactly. They're effectively getting around every other state's usury cap. And this ability to charge high interest nationwide, it transformed credit cards from those loss leaders we talked about
Into a major profit center.
a massive one. And this shift is the foundation of the modern revolving credit model, which really relies on customers who carry balances. It also enabled the rise of what we call risk-based pricing.
And this is where it gets really important for the average person, because this history is why most of us now pay around 21%. A bank knows a borrower is risky, so they can charge them 25–30% to offset that potential for default.
Right, and the banking industry argues that if you take away that flexibility, that ability to price risk, you kill the whole mechanism that provides credit to anyone who doesn't have pristine finances.
That is the central tension of this whole debate. The Marquette ruling created the high-interest, high-access market we have, and the banks are now warning that if you reverse that, you're cutting off the very people who rely on that high-cost access.
So this current debate isn't just about fairness, it's really about viability.
Yeah, that market reaction, Synchrony's 8.7% plunge, it shows investors really do believe that this risk-based pricing model is critical.
Especially for those specialized lenders, they rely on those high margins to cover the severe risk of default from their core lower FICO customers.
That risk cushion is everything to them.
It's vital. We know credit card default rates can spike, dramatically during a recession. It can wipe out years of profit for a bank that isn't well capitalized.
And the industry argues that the market is so concentrated now with the top 10 issuers controlling, what, 80% of the market?
80% of the total market share. They argue it's concentrated precisely because lending to risky borrowers requires huge capital buffers and this incredibly specialized risk modeling that, only the biggest players can support.
Wait a minute. We actually have a functional counterexample to this whole we will collapse argument, one that cap proponents love to bring up. Not all lenders operate in this deregulated post-Marquette world. Federal credit unions, or FCUs, they do pretty well under a cap.
That's a critical point and one that's often left out of the public debate. Federal credit unions, which are mission-driven, not-for-profit, they operate successfully under a cap that's consistently set by the NCUA at around 18% APR.
18%. So that functional model proves that a healthy, accessible credit system can exist and be profitable well below the 21% national average.
It certainly suggests it's possible.
So if the banks are claiming a 10% cap would destroy them, but FCUs are doing fine at 18%,
Right.
I have to look at the bank's actual financials. You look at the Federal Reserve analysis. How high are these profits that cap opponents are talking about?
Well, the data shows the profit margins in the credit card world are immense compared to general banking. We're talking about return on assets or ROA.
Okay, for anyone who doesn't speak bank, what's ROA?
It's basically how much profit a bank generates for every dollar of assets it holds. A healthy, average bank might have an ROA of 1%, maybe 1.5%.
Okay, so what's the ROA for credit card banks?
The average ROA for credit card banks is often 3 or more times higher than the average bank. But what's really surprising is that this profitability is maintained across all risk tiers.
Wait, all of them? It's not just the prime borrowers who are profitable?
No. For customers in the, let's say, moderate risk 600 FICO tier, the average ROA is still 10.82%.
10%. That's huge.
It's massive. And even the highest risk FICO tiers maintain a positive ROA of around 2.5%. So the data suggests banks make a lot of money from all of their customers, even those who default sometimes.
That completely reframes the debate. The idea that safe borrowers are subsidizing the risky borrowers, it looks, well, questionable. It seems like every single credit tier is generating exceptional profits.
That's the argument from the cap proponents. But there's another layer here we have to talk about, which is the unique revenue stream that credit card banks have.
You're talking about interchange fees.
Exactly, interchange fees.
So explain that for everyone listening. What is an interchange fee and why does it matter in this debate about viability?
Okay, so interchange fees are those small percentage fees, usually 1 to 3%, that banks charge merchants every single time you swipe your card.
And critically, they're paid by the merchant, not by you, the card holder.
Right. And they are enormous. We're talking billions of dollars a year. This fee stream generates massive, steady revenue for the banks, which makes their whole business model much more resilient to, say, a tap on the interest rate itself.
Because they don't just rely on interest payments.
Not at all. So if they lose some interest revenue from a cap, they still have this huge protected revenue stream from interchange that other lenders, like mortgage lenders, just don't have.
Which makes their threat of an immediate collapse seem less credible, at least to the people who want a cap.
Yes, exactly.
So let's analyze the impact of that severe 10% cap using this data. We know it would generate an estimated $100 billion in annual savings for customers.
$100 billion, and that's concentrated in the mid-FICO range, like 640 to 740, because that's where the biggest balances are held.
That's a colossal benefit for the American household. But that saving has to come with some painful trade-offs that the banks are warning about.
The adjustments would be unavoidable to stay viable at 10%. The financial modeling shows two main casualties. First, banks would have to cut rewards programs.
So cash back, airline miles.
All of that. They'd need to reduce those by about $27 billion for customers with FICO scores below 760. The cost just gets shifted from interest over to reduced perks.
It's a big hit to consumer perks, but it's not the biggest threat, right? The most significant and maybe unintended consequence is the contraction of credit access.
Absolutely. To hit their profit margin under a 10% cap, lending volumes would be drastically reduced, maybe even eliminated, for customers with FICO scores below 600.
So this is the core of the industry's warning. The cap gives $100 billion in savings, mostly to the middle class.
But the collateral damage is a massive cut in credit access for people on the financial edge.
What about those alternatives? You mentioned the FCU model. What if Congress decided to go with a milder cap?
Well, if they chose a more moderate cap, the impact is dramatically less severe. A 15% cap, for example, would still save consumers $48 billion a year.
And it wouldn't require those huge cuts to rewards or lending.
Right, not nearly on the same scale.
Okay, and what if they just adopted the credit union model and set the cap at 18%?
An 18% cap is the least disruptive.
Yeah.
It would still save about $16 billion annually and maintains healthy profitability at every FICO tier. But it has a strange potential side effect.
Which is?
The data suggests that if a federal cap is set, that high FICO customers, people above 760, could actually end up paying more in interest.
How could that happen?
If the banks decide to coordinate their rates upward to meet that new federal ceiling.
So the regulatory floor becomes the new market ceiling, and it ends up hurting the safest borrowers. That is the definition of an unintended consequence.
It is.
So what does this all mean? The debate really pits these massive, quantifiable consumer savings against the foundational risk model of American finance.
Right. Critics argue the profit margins, which are propped up by that 1978 Marquette ruling and the interchange fees, are just so excessive, they prove there's a market failure that needs government intervention.
But the banks warn, and the financial data on credit contraction seems to confirm, that imposing the most aggressive cap destroys the very mechanism, risk-based pricing, that provides credit to the riskiest parts of the population.
And if the system is capped, the whole profit dynamic flips. Right now, high-risk customers generate the highest returns. A 10% cap would reverse that completely. You'd see higher ROAs for safe high FICO customers and lower returns for low FICO customers.
So the ultimate question for Congress isn't just about saving people money. It's about, really, social engineering through finance. When they decide on this cap, should they prioritize stripping $100 billion in profit from the banking system, knowing the cost will be locking millions of low FICO individuals out of traditional credit?
Potentially damaging their ability to build wealth or even participate in the economy.
That trade-off between savings for the many and access for the few on the margins, that is the real shockwave of a 10% cap.